Now, another thing that we have to take into account when we are talking about making our money last and making sure that we have enough money for the future and that our retirement savings do not outlive us is taxes. Because taxes are reality for all of us. We have to understand what the tax implications of the monies that we've saved are. And one of the ways that you can make sure that the money that you have saved is going to be the money that you actually get to put your hands on when you are retired is to invest in tax-free vehicles and things like the Roth IRA or the Roth 401k. And I know for some of you, your income may be above the limits for the Roth IRA, and that's perfectly fine. If your work offers a Roth 401k, then you can take advantage of that. There is no limitation as far as income goes. And so if you can contribute to these types of vehicles, then you need to be doing so regardless of where you are in your life right now. Because what you can do is you can set yourself up to having tax-free income in the future, not having to pay taxes out of the money that you have. Because let's just go back to that previous example that I had. If you had $1 million nest egg and you were pulling 5% off per year, and that's $50,000. Well, if you're taking that from a Roth IRA or what was in a Roth 401k or 403b, you take that money out and guess what? You have $50,000 and you will get to keep the entire $50,000. But let's say that money were in a traditional 401k or traditional 403b or traditional IRA. Well, those monies are pre-tax money. Any money that you put into a traditional IRA or 401k or whatever it may be has not been taxed yet. And so any type of money that you have in there, when you take it out, there are going to be tax implications to taking that money out. So let's say you took out $50,000. Well, you would have to pay taxes, state and federal taxes, on that $50,000 that you took out. And so, you may then be looking at only 40,000 or, the upper 30s as far as what you actually get to take home from that account. And that can be detrimental to your ability to making your money last. Because if what you need is $50,000, if what you need every year is $50,000 and you've got that $1 million nest egg, then, and let's say you have a traditional IRA that it's growing in, then you're actually going to need to make more than 5% a year to create the income in order to live off of it and in order to get the $50,000 that you need. You're going to have to take more than $50,000 out of that account every single year in order to just get down to the $50,000 in actual net income that you are going to need. And so this is very important to take into account, because if you are not saving in tax advantaged vehicles, such as the Roth IRA, Roth 401k, and obviously the traditional options are also tax advantaged because things grow tax deferred. The money grows tax deferred, and when you put the money in, you get the tax benefit there. But on the back end, you're actually hurt. So you need to make sure that as you're going into retirement, you understand the tax implications of the money that you have. And understand that if you do have pre-tax money, you're actually going to have to pay taxes on any of that money. Therefore, you are going to need to take out more than what you actually need every single year. But if you have the Roth IRA, Roth 401k, 403b, those Roth options, then you'll be able to take that money off tax-free, therefore requiring less in the way of returns and requiring taking less money off of that retirement account every single year. And so keeping that in mind, and as you are pushing towards retirement, keep Roth in mind. And if you can take advantage of it, definitely take advantage of it. And you will not be sorry, because the less taxes we can pay on the back end, the less costly it is to get our money on the back end, then the longer we can make our retirement monies last.